So New Change was set up 5 or 6 years ago with the intention of providing analysis in foreign exchange for institutions, principally to understand cost. Toby and I set up the business, and we had been asset managers for 10 years before that. And we recognised when doing that job that it was very hard to get a firm understanding of the cost of execution of foreign exchange. So that was the founding principle of the company. What we ended up doing was realising that the biggest problem in understanding foreign exchange costs lies in the fact that there isn't any independent data. It's almost impossible in a fragmented market to identify what a fair mid in the market is. Any broker will tell you what the mid is, but of course it's the mid for that bank or broker. So, there's a circular element to measurement in foreign exchange which is deeply problematic if you're a customer. So we realised this very early on, and we set about trying to solve the issue of fragmentation and data. And we now produce a live, it updates every 50 milliseconds, so 20 updates a second, a live feed in 72 traded currency pairs in the spot market. That is registered under the FCA under ESMA rules. It's the world's only live spot benchmark. And that provides people with an independent measure of the mid of the market against which they can compare their executions in order to understand the cost of the transaction. The point of the rate is that it cannot be traded. We don't offer any trading services. So it can't be directly affected by the execution that the client is doing at that time. So essentially, if you want to know what your foreign exchange costs are, you need a rate that is nothing to do with the execution process that you're engaged in. You have to measure a system from outside the system. Well, it's extremely difficult anyway. The point is you have to build the same technology that any price aggregation system would build in order to capture and consume the data. But you're not monetizing it in the same way. You're not monetizing it by putting trades across it. So it's taken a long time for that to become a story that people understand. And use. So the period between setup and money was long, and it took a long time to sustain that. And we sustained ourselves by doing lots of analysis for clients, which we still do. But now the data, people are recognising the quality of the data and the value of an independent rate in their systems, and so the data is becoming a much more significant part of our business. At its most simple, it's simply comparing an execution price and timestamp to the independent rate timestamp and price, and from that assessing in simple dollar terms what has been paid. Of course, the analysis goes a lot deeper for clients who want to understand their market impact, both temporary and permanent, implementation shortfall, information leakage, those kind of things. Those are forms of analysis that can easily be done from this data. And we're now moving into the world of pre-trade analysis. So we have an expected spread model, and we've recently built an efficient frontier model that indicate where an efficient trade would have been done, against which it kind of introduces a concept of alpha and beta into foreign exchange. We have clients who execute extremely well and take advantage of modern techniques, aggregation, those kinds of things, in order to achieve high quality execution for their customers. That, without a doubt, there are a lot of people who take this stuff very, very seriously. At the same time, there's a lot of people who, the sort of schoolboy error is looking at foreign exchange as a question of spread, as opposed to looking at it as a question of spread and skew. And of course, so very simply, you need to understand what the spread is and how far that spread is, which side that spread is being lent to, if at all, for your pricing. So we find with, particularly in the sort of more passive end of the market, where managers are executing because they are buying non-base currency denominated assets, there's a tendency to ignore this. And of course, there's a great deal of, where the business is totally predictable, there's a great deal of cost that comes from that. So it's fundamentally a very efficient market. And I think when you look at the sharp end of the market, where people are paying $2 a million, $3 a million for execution, that seems reasonable. That's, the price making that's happening at that end of the market is very good. But I would say a majority of our clients, certainly when we first see them, are paying $400, $500 a million, and we see quite egregious $2,000 a million kind of costs occasionally, which is obviously a vast multiple of the efficient liquid end of the market. So it is true to say that it's efficient and liquid, but it is not true to say that everybody benefits from that. Well, as I say, we were asset managers, so we were looking after foreign exchange portfolios, and we were responsible for roughly 1 million trades a year. And we realized in about 2006, I suppose, that we needed to be understanding the cost of those transactions, because obviously the cost of the frictional cost of those executions on the fund was significant. I mean, it was an FX-focused product, so there was clearly, a great deal going on. And we realized there were lots of issues, particularly around our share class hedges. We had 18 share classes, and managing those was A, it was tricky, and B, it was expensive. And those were the thoughts that occurred to us when we got the opportunity to start the business. Our first client was a very big CTA. And they were doing an enormous volume of transactions. And in those days, we were using a data source that wasn't 100% reliable. They had gaps in the data. I'm sure it's fine now. But we had to patch the data. And what we found was that every time we patched the data, the costs were higher. So this is where this concept of circularity came from. We realized that the data we were using in the majority of the measurements was coming from the trading system that the client was actually using. And as a result, some element of their cost was being cloaked by the data and the trading coming from the same place. In fact, it became very obvious that quite a lot of the data we were using was in fact transaction data that was being generated by the client, so entirely circular. So that was where we started thinking about data as the principal issue. So dealing with the fragmentation of the market became the most important thing to us, and that's why we aggregate prices from lots and lots of marketplaces, and that aggregation produces the mid-rate, and that is published regularly. And we do the same broad thing in forwards, though obviously not at the same frequency. And that produces a benchmark which can't be traded, against which to measure. So that was the process we went through to arrive at the product, and coloured entirely by our background as asset managers and not traders. We'd been traders long before that, but it was that combination of skill sets, if you like, that informed the product. I think if you were to look at the asset management world that is deeply involved in foreign exchange, be it for speculation or the very large traditional asset managers, one would say that they're pretty aware of it. I think the regulatory situation has clarified that in people's minds. What we find is that there's an awful lot of asset managers who are focused on their long-only strategies, particularly long-short equity, those kind of areas where they don't have a natural affinity for the foreign exchange market. They probably don't employ people who've got experience in the foreign exchange market. And it's really those clients that we're able to add a lot of value to, because of course they're the ones who have the biggest cost at the start. And frankly, the costs are optional. It's normally a question of simply calling a provider and saying, look, I'm measuring this stuff now. I'd like to get these costs down. What can you do? And obviously providers are, they don't volunteer this stuff, but they're willing to move in order to keep a client. And we see costs moving lower very, very quickly on the back of a phone call, backed up with good information. And I think that's really where we see the sweet spot for the product. Arguing over whether execution was as good as it could possibly be at the very, very sharp end of the market is a slightly limited game. You have to pay for foreign exchange execution if you're transferring risk. But in the area of still very large fund managers, but where they haven't really thought about the foreign exchange, there's a great deal of value to be won instantly. Well, my advice to anybody is measure and understand what you're paying. It's very, very simple to do, and it doesn't require enormous investment in time and effort, but will start to highlight who are the best brokers for the types of business that you're doing, which people have a natural interest in the particular currencies that you're looking at. And that form of measurement will inform trading and just simply make trading more efficient. And obviously the more you're efficient, the more you will trade, so there's a sort of a payoff benefit to both sides of the equation. But it's just understanding exactly. The other point is that you need to be able to compare brokers. And of course the analysis from one broker is not comparable with the analysis from another broker. So very simply having the neutral rate against which to make comparisons starts to give proper information to the trader. And I would say anybody who is professional, well, it doesn't matter what you're doing, the cost of your raw materials must be considered in your activity. This stuff isn't free, so you should be buying from the supplier who is best for you, and you can't do that without some form of measurement.